If you had ever lived on the ground floor of a building before, one of the things you will observe is that the view of the area is limited, in which I've been opportune to live on the ground floor. And when you move up to 6th, 7th, 10th floor, you observe another thing, that you have an holistic view of the area in which you are located. Likewise is corporate reporting in the finance world and accounting world. Is the apex of financial accounting, is the apex of corporate reporting, and you being on this level now, it is expected of you to have a general and holistic view of the financial accounting and corporate reporting. So you must have had background in advanced audits, financial reporting, business law, financial accounting, taxation, and the like before you can reach corporate reporting. And having gone through that, you are already solidified to have all these competencies expected, much of which we had already done with, but for the sake of people that are just joining us now, we'll just recap it. For corporate reporting, it's expected that you must have gathered the competence in the area of financial statement preparation, interpretation, analyzing, ratio analysis, and the like. It is expected that you have understood all these and many more. Be able to have policy, accounting policy implementation, and the like. Be able to manage business risk and the like. So those are the competencies that are expected at this level that you must have had. Also, the major breakdown of corporate reporting is broken down into 5 parts: the regulatory framework and ethics. Meanwhile, ethics is spread abroad on all the courses of the institute. It is 10% of the syllabus. Reporting on entities' performance to stakeholders is 20%. So we must be very good at reporting and writing write-ups at this level. Also, group financial statement. I want to believe you know already that we can't escape group financial statement because it's a bit complex, and at this level we must understand it. So its weight is 30% of the course. Also, current developments in and beyond the financial reporting, it is expected that we know the latest in the industry, 20%. And last but not the least, your ability to interpret, your ability to analyze and have holistic view of the syllabus and of the financial world and financial accounting is 20%. Having gone through other areas of the coverage of our syllabus, in which we had already examined examinable IESEs and FRSEs. So we are going to move on to other topics that we have that we've not discussed in part 1, and we'll continue to discuss them. Basically, they are topics and jugular topics that we need to know and prepare ourselves for in readiness for passage as a chartered accountant, and people in finance world, or anybody that has interest in finance and accounting. So IFRS 16 is about leases, and at this stage it is expected of us to understand what lease is, who is a leasee, who is a lessor, how are we going to prepare the account and the record of a leasee and a lessor, and should in case we have an agreement as regards sales and leaseback transaction, how are we going to record the accounts. So those are the jugglers that must be covered under subtopics under leases. Therefore, IFRS 16 is critical to our knowledge at this level. must be able to identify leases. And what do we mean by that? There is not only one lease. We have different types of leases: the finance lease, the operating lease. So we must know what makes a lease finance lease, what makes a lease an operating lease rather, so that we'll be able to keep the accounts as it is expected based on the concepts and framework that regulates the individual leasing. Residual value of the lease item, how are we going to manage it? The interest rates implicit in the lease, how are we going to manage it in the books of account, whether the leasee or leaseur's book? These are critical knowledge that we must have. Leaseur's accounts, how should we account for it? The operating lease in his book, if they were to be manufacturer or dealer and the lease out, how are we going to account for it? But we have lease back transaction at hand. How are we going to deal with accounting for transfer that happen for the sales? What of accounting for the transfer that's of sales and for lease back? How should we account for transfer of the items that are actually sold? These are the critical knowledge that we must garner here. Lease classification. Land and building, especially we lease land and building, especially land. We know land cannot be depreciated. How are we going to manage it in the book, and how are we going to account for the separation between the lease land and the lease building? Also, lease charges, how are we going to account for it? The interest. Lease payments made in advance, how must we record it? Remeasuring of lease liability, lease modification, because lease are actually for longer period of time, and a lot could have happened that will make both the leasee and the lessor to sit down again and renegotiate. So when that happens, lease modification comes in, and how are we going to address it and account for it? These and many more are what we need to know under lease. Now comes to income taxes under IAS 12. We must understand here the basic approach, especially when it comes to deferred tax. We must be able to recognize deferred tax, whether it's an asset or as deferred tax liability. Deferred tax when it happens under business combination, how to account for it. Necessary presentation and disclosure as it relates to IAS 12, we must understand at this level. Deferred tax accounting can be challenging. So how are we going to preempt problems or challenges on the way, and what are the approaches recommended by IAS 12 for us to resolve the underlying issues with deferred taxation? How are we going to identify deferred tax balances, whether as asset or as deferred tax liability? Sources of temporal differences in deferred tax, and how should we account for them? Taxable and deductible temporary differences, we must understand it. We must understand the evaluation of assets and liability in the fair value exercise. Unremitted earning of a group company, how are we going to manage it concerning the tax liability that it carries? When we have unrealized profits or unrealized gain, how are we going to adjust for them? Change in recoverability of parent deferred taxes. as assets or as liability, especially during acquisition and business combination. We must be able to account for them and record them properly at this stage. Then IAS 19, which talks about employee benefits. Basically, two jugulars under it are employees benefits and post-employment benefits. Employees benefit deals with when we are in employment, and post deals with after we have disengaged. So for employee benefits, what are the scope and basic principles that IAS 19 recommend and suggests? The short-term employee benefit, how are we going to manage it? And when we're talking about employee benefits now, it varies from country to country. So as a person offering corporate reporting at this stage, you must understand your specific countrywide, nationwide employee benefit and how it's being calculated and the like. Termination benefit. We'll see that under this, we can't talk about employee benefit without talking about human resources too. So human resources angle of country, labor act and the like must be considered too. And at this stage, we must have knowledge of labor act. Other long-term benefits that we may accrue to an employee in employment. And when it comes to post-employment benefits, we have the defined contribution, pension contribution plan, defined benefits, pension plan. These are post-employment benefits. Then, what are the asset ceiling? It's possible for organization to have asset ceiling, multi-employers plan, especially for people that move from one organization to the other and the organization are under one umbrella. How are we going to gather together their information and post it as one unit for a particular employee that has already disengaged? What are the rules? What are the procedures? What are the past service costs associated with the post-employment benefit? How are we going to gather? How are we going to account for them? These are things that we must understand. Accounting for defined benefit pension plan and the alternative approach to it. Accounting for defined benefit pension plan. We must understand very well the scale and the rule, whether as in organizational policy, nationwide policy, as they affect post-employment benefits. Moving on, we'll now be looking at share-based payment. Share-based payment, especially this may affect more people that are at the apex of the ladder in form of director in an organization and the like. And that is not to generalize, because some organization too can even have it for management staff and all levels of staff depending. But what I'm trying to say now is that share-based payments may not involve all employees. Under IFRS 2, we must understand the measurement of equity settled share-based payment. Also, we must understand and be able to account for measurement of cash settled share-based payment transactions. Measurement of share-based payment transactions with cash alternatives. And what are the requisite disclosures that we must have and abide with. This breakdown have other breakdown under them that are important to the discussion and to our reading plan. For measurement of equity settled base share payment, we'll be looking at the direct and indirect measurements. We'll be looking at how should we recognize equity settled share based payments in the accounts, modifications to the term and condition on which equity instruments were initially granted, and after equity instruments are vested, how should we account for it? Under disclosure, we must know about disclosures about nature and the extent of share-based payment and the arrangement we had. The disclosure about the fair value measurement. The disclosure about effect of profit or loss for the period and the financial position that we currently have. We must understand share appreciation scheme and how it works and affects and influence equity settled share-based payment. The effect of vesting condition on the measurement of cash settled share-based payments. We must understand how to account for a modification of term and condition when it happens. We must be able to classify very well the share-based payment transaction with settlement features, depending on whether it is cash-based or it is share-based settlement. Also, and this is tricky, when we have an agreement on share-based payment transaction, but which has cash alternative, how are we going to handle them? What should we do? How should we account for them? These are the things that we need to understand in these regards. So, fair value measurement is what we'll be looking at under IFRS 13. IFRS 13 deals with fair value measurements. So we must understand valuation technique, the liabilities and the entities on equity instruments, and disclosures that are expected of us to make under IFRS 13. The general accounting, acceptable accounting principle and practices, and the instruments that we can use, the measurement methods that we can use, the classification and measurement of financial assets, impairment of financial assets, how should we deal with financial liability when they arise, hedging, when we hedge, what are the instruments we can hedge with, the qualifying criteria for hedge accounting, what are the qualifying items, what is hedging itself. We must be able to answer this before we finish this particular topic. Cash flow hedge based adjustments, and when we are hedging and we have a net investment in foreign operations, how are we going to account for them? So like I said when we are starting, now we are no longer living on the ground floor. We've moved on to the apex of the ladder. We must be able to tackle all this and have a broader overview of what accounting world really is as at now. Moving on to financial instruments, the presentation and disclosure as a topic. IAS 12 and IFRS 7 deals with this. IAS 12 deals with its presentation of financial instruments, and more of disclosure comes from IFRS 7. When we are talking about the presentation of financial instruments. We must understand the liability and equity side of things, the preference share and how it affects and how it should be recorded as a debt or as an equity, compound instruments, and how to calculate all those compounding interest and the like. Transactions in own equity. Should we offset? If we should offset, how should we offset? Against what can we offset? And against what can we not offset? Distributable profit. Now, when we are talking about disclosure, as it relates to the statement of financial position, statement of profit or loss, or other comprehensive income, and the disclosure about the risk involved in the financial instruments that we are carrying. Let me pause say, it's possible we have questions even from the part 1 of corporate reporting review that we've done, and this second part. Let us know comments. If you have any comments, if you have anything you are looking forward to from us on this channel as regard corporate reporting, let us hear from you as we move on to sundry standards. These are other standards that we need to understand at this level. We've dealt already with retirement benefit plan. Then people in agriculture, IAS 41 deals with it. Exploration for an evaluation of mineral resources, IFRS 6 deals with it. And under IFRS 6 for exploration, we must understand the initial recognition and measurements. And this is critical because it's possible we have a dry well. How should we handle dry well? Subsequent measurements, presentation, impairment, and disclosure on explorative and evaluation of mineral resources under IFRS 6. Another sundry standard is on regulatory deferred or deferral accounts, IFRS 14. Then SMEs IFRS, because the bulk of this IFRS actually deals with the multinationals and the big organization. But nevertheless, it is considered that have IFRSs too, but at a lower scale and at, how should I put it, less penalty and less strict regulatory implication. Last but not the least of this sundry standard is on accounting for NGOs, that is not-for-profit making organizations. Then we'll move on to the business combination and consolidation. Business combination and consolidation as a topic. Consolidating the financial statements is highly critical knowledge we must have at this level. We must have had a bit of it, but now we must condense it. Accounting for goodwill. Under business combination, acquisition method, recognition of goodwill in the accounts, consideration, how to calculate consideration, the cost, acquisition dates, amounts of assets acquired, and the liability assumed. Must be able to dissect it. Accounting for goodwill, negative goodwill, positive goodwill, bargaining purchases, impairment testing of goodwill. and that must even come before payment of purchase consideration. So general accounting for goodwill knowledge is important to us. Then consolidated statement of loss and other comprehensive income. So we must deal with intercompany related items, minority interest calculation, pre and post acquisition profits, general knowledge of consolidated financial statement of profit or loss. Basically, we must have at this level. And I must say, if we are yet to subscribe to the channel, please let us like, subscribe the channel. If you enjoy the knowledge you are having in this channel, please share to other people so that they can be beneficiary of the good work and the effort that we are putting to make sure you have tutorial online. Associate and joint venture. IFRS 11 deals with joint venture. IAS 28 deals with investments in associate and joint venture. And when we are talking about joint arrangements, what are types of joint arrangements? You must be able to itemize them and know the differences and the similarities, their advantages and their disadvantages at this stage, and how to account for joint operations and joint venture. Investment in associates and joint venture, the trading with associates and joint venture, arm's length rule and the like, we must understand. Business combination. Under business combination, we'll be looking at acquisition achieved in stages. The stages of acquisition we must understand, then the pattern of ownership in the consolidated statement of profit and or losses rather. So steps of acquisition we must understand. Purchase of additional equity interests after control is already achieved. I want to believe we understand that. Anyway, by the time more elaborate discussion comes, we understand it better because this is an overview of the syllabus. Purchase turning significant influence into control. It was significant before, but not a control interest. Now, how can significant interest turn to a controlling interest, and how should we account for it in the records? Disposal of subsidiary. Now, when we have subsidiary but for one reason or the other we can let go of them, how should we account for them? Partial disposal, full disposal, disposal of subsidiary with which does not contain a business. IFRS 5 release with it. How should we present the presentation of a discontinued operation in our record? How should we account for the disposal, the proceed, and the like? Other group standards that we must understand at this level are IAS 27 and IFRS 12. IAS 27 deals with separate financial instruments, and IFRS 12 deals with disclosure of interest in other entity. So how should we calculate and account for interest in subsidiary? Structured entity. When we have a structured entity and we are disengaging one of the subsidiary from us, how are we going to manage it in the account? The interest in joint arrangements and associates, how are we going to split the coin, and how are we going to record going forward? foreign currency. IAS 21. The effects of changes in foreign exchange rates, may it be the fixed rate, the floating rate, the individual entity, the accounting rule, the foreign operations accounting rule. We must understand IAS 21 very well. We must know the 3 stages in the consolidation process or processes, the term and definition of IAS 21, especially as it defines currency definition rather. How should we go about the challenges that come with foreign currency, basically, which may be in form of twofold: exchange rates. Which rate should we use, and if we have gain or losses arising from exchange, how should we account for it? We need to understand all this. The reporting at the end of each reporting period, the gain, the loss, how should we report them? The settlement of the transaction that we executed, how should we record it? Disposal of foreign subsidiary, how should we record it? Now we are not talking about local subsidiary, we are talking about foreign subsidiary. How should we record them? The consolidation method that we need to know, and the stages we need to pass through in recording and complying with IFRSes. Statement of cash flows. When we're talking about statement of cash flows, we must understand what are items under investment activity. We must understand what are items that we must disclose under financial activity, what are items to be disclosed under operating activity. Before, we've not been discussing about consolidated statement of cash flow, but at this level you will begin to hear things about consolidated cash flow statements. Non-controlling interest and associates, you need to prepare their cash flow. Acquisition and disposal of subsidiary in the cash flow statement. So we need to know, will it be under investment activity, financing activity, or operational activity? So these are the technical aspects of statement of cash flow that we must know when we are preparing it, especially when we are preparing consolidated statements of cash flow. So there are different formats of statement of cash flow. Basically, we have two. So you need to learn them and know them at this level: the direct method, the indirect method. Working capital adjustment, you need to know. Then under acquisition and disposal of subsidiary in the statement of cash flow, we need to know the notes to the statement of cash flow and how to ensure that we have full disclosure under our notes. How to avoid double counting when a subsidiary has been acquired. Disposal of a subsidiary in the statement of cash flow. We need to know how to incorporate all these and many more under acquisition and disposal of subsidiary. As a matter of accounting, strong accounting concept, we need to know at this level whether an activity, let's say for example investment activity, is contributing to our cash outward flow or cash inward flow. Sometimes it may be a bit technical. We need to understand this at this level, like cash paid for the purchase of property, plant and equipment. Is it adding to our cash flow inward or cash flow outward? So is it going to be in the jacket or is it going to be an addition? Cash from disposal of property, plant and equipment. How are we going to treat it in statement of cash flow? Cash paid for the purchase of investment too, and cash received from the sales of our investment. And under financing activity, we need to be able to recognize two activities that we can call financing activity. Cash from new share issues, cash from new loan, dividend payments to equity shareholders, repayment of leases, change in liability arising from financing activity, and many more. And how should we treat them? Consolidated cash flow statements. We must understand the special feature of a consolidated statement of cash flow from the normal company or single organization cash flow preparation. Non-controlling interest in an associates JVS, that is joint venture, in cash flow statement. How are we going to bring all these interests, various interests in the cash flow statement? Dividend paid to non-controlling interests, that is the minority shareholders, foreign exchange adjustments. When we have associates or we have the transaction under joint venture, how are we going to treat them? How are we going to calculate dividends from associates that we've received? Moving on, earning per share under IAS 33. PE ratio, that is profit earning ratio, and earning per share ratio. We must be able to calculate all those ratios, and the technical aspect of it, by the time we go into those topics, we are going to debunk them one after the other. Diluted EPS, we need to know how to calculate the basic earning per share. Presentation and disclosure requirements under this IAS, we need to know how to do a performance measurement using our earning per share and how to interpret it. Then when we are talking about diluted earning per share, we'll be looking at options and warrants, employees share options, convertible preference share, and convertible bonds. Potential ordinary shares that are not diluted yet, contingently issuable shares, actual conversion during the year, and how are we going to manage them? All this dilution in our ordinary share capital and capital base generally. How are we going to present it based on IAS 33? We need to understand them. The limitation of earning per share is interpretation and the like, and where to avoid pitfall using it or recommending action based on earning per share alone. Analyzing and interpreting as another topic under corporate reporting. Common size analysis. These are basic analysis that we can easily do and are familiar with. Then we'll move on to return on capital, profitability ratio, asset turnover ratios, and by the time we get to that stage, I will be telling us how to easily identify all these things so that we will not, because oftentimes students miss these things up. We mix them up and we'll be cracking our brain. Okay, this ratio, what and what should it be on? But actually all those names are meaningful and we can easily remember what to put on what should be the numerator, not what should be the denominator. I will be telling us by the time we get there. Working capital efficiency ratio, liquidity ratio, debt ratio, investors ratio, limitation of interpretation techniques, and how we can easily understand and interpret any financial statements. These are the techniques that we will be learning here, because it's almost as sure as anything that we are going to have in our exams an interpretation question, because that's the stage at which we are now. First time adoption of IFRSes. When an organization is just starting, by now actually a lot of organizations had already metamorphosed using IFRS standard of accounting, financial accounting preparation. But nevertheless, we must familiarize ourselves with these requirements. Up next, we are going to be looking at content of directors reports in this channel. The list of items that, as per code of conduct, the directors supposed to talk about in their reports. Don't forget that we have management reports, we have directors reports, we have chairman's reports inside the same financial statements, and there are a lot of other reports that even are not from accounting side of things that must be included in the annual report. So these are the things we'll be dealing with. We may be asking, especially for those that are just joining us on this channel, who's been talking. My name is Gbenga, Olatunji FCA. I have over 20 years experience in this accounting world. James Associate is our channel. Don't forget to like and subscribe. Click the notification button. Share it. Share to other. Let your friends, let your neighbors be aware of James Associate channel, so that we can build this community of knowledge together. We pride ourselves in saying that we are value to life. I want to believe you've received value. We are value to your businesses. So next, we'll be talking about content of directors report.